This is the most vulnerable market there has ever been. And given the incredible record of the past, that the highest multiples do not predict good times, but have historically predicted the worst times, it should give you cause for some concern and some caution. The highest possible pricing, the highest possible PEs will be followed not just by tough times, but some of the worst times that occur. My main interest in the market has been as a historian, and therefore I'm cursed with a much longer horizon than 99% of the players. And I've done my best to tailor to that and live with it. But as a historian, you have to say, if you look at the broad sweep of history, you have to be impressed with how incredibly bad the marketplace is as a judge of the future. So if you'll bear with me for a second, just let's go back to 1929. It's the highest PE on trailing earnings up till then in history. By today's standards, pretty modest, 21 times trailing. The earnings, however, have spiked. They've done brilliantly well. The economy is booming like it was China in its heyday, probably the most rapid period of growth in American history. Double-digit increases in industrial production, that kind of thing. And it peaked in September 1929, September, October, 21 times trailing. And how good was that? It was the highest price in American history. What was it projecting? It was projecting not just ordinary times, not good times. It was projecting the worst 10 years in American economic history. So you had the highest PE, the greatest bull market, not a few years before, a few days before the beginning of the biggest wipeout in fundamentals, not the stock market. Yes, the stock market went down colossally, but the economy collapsed, the global economy, international trade, currencies, everything went to hell immediately following the greatest bull market in history. So you have to ask yourself, what was the market doing that it not only couldn't see trouble coming, but it apparently saw heaven coming? It could not possibly have been more wrong. So you fast forward to Japan, which is in a way the mother and father of all bubbles. Japanese market had never sold over 25 times earnings until it did in 87. By 89, it was put to us that it was 65 times earnings. As far as we could tell, the Japanese market was 65 times trailing earnings, never having sold above 25. So it had gone up. And this is what should put the fear of God in anyone trying to time the market. It had gone up 150% more than it ever had in history. What did it predict? From the day it hit its peak in late 89, you had a lost decade, arguably a lost 20 years. The Japanese growth went from sensational to miserable. The Japanese market for 8 minutes sold at a larger value than the US market. For an economy a third as big, it was incredible. And again, we had a sensational PE, not predicting good times, but predicting the worst times that you could possibly have wished for Japan for the next 20 years. If you think about the great financial crash, it wasn't the highest PE in history, but it was pretty darned high the other day in early 08. And again, from a very high level, third only to 1929 and 2000 tech bubble. Instead of predicting good times, it predicted the worst financial crisis in modern history, which nearly brought the entire developed world to its knees and needed the most sensational bailouts and injection of liquidity, etc., to save our bacon. Incredible. So if you look at the three great events, or three of the four great events of the 20th century, you have to say absolutely spectacularly wrong. Peak multiples projecting the worst periods of our history. Well, I often quote Hussman. He produces very good data. The model that he uses that has the highest predictive value, measuring the value of the market, is slightly higher today than it was at its two previous peaks, 1929 and 2021 December, just before the fairly decent decline of 2022. And now we're slightly higher. This is on the most predictive measure of value that he has produced, and he's worked at that, as far as one can tell, constantly for 30 years. This is the most vulnerable market there has ever been. And given the incredible record of the past, that the highest multiples do not predict good times, which you learn at business school, but have historically predicted the worst times, it should give you cause for some concern and some caution. And of course, the market does not feel concerned or cautious. It didn't in 1929. It didn't in Japan in 89. It didn't in the US before the housing bust of 07, 08. That's the way the market is.